recording, yeah. And also we discussed about what is to be included in the cost of the asset. The cost of the asset includes the original price of which is paid to the supplier of the asset, original cost which is paid to the supplier of the asset, the main cost of the asset you can say, plus all the costs which are incurred to bring the machinery up to this point, all the subsequent costs until the asset is put into use, including the training cost, trial cost, etc., etc. So the machine has to be brought from the supplier place to our factory. If it is a machinery, all the subsequent expenses what you incur from here to here, this amounts plus what amount you paid to the supplier, okay, and subsequent expenses plus installation charges plus any training costs and trial costs. This amount becomes depreciable base. Depreciable base means the depreciation is calculated on this total value from here to here. You might have paid only 100,000 here, okay, but subsequent expenses and all are say 20,000. So your depreciation will be 120,000 times the percentage, not 100,000 originally what you paid. One second, I will mute somebody here. I'm getting some voice. Is it okay now?
Yes.
Yeah. So this is called depreciable base. Depreciable base means the total amount paid until the asset is put into use. Okay. Please write an important note that any negligence which is incurred while handling this asset is not to be included in the depreciable base. It doesn't go to the asset value. Any negligence, cost of negligence is not to be included in the asset value. Also, any discounts received at the time of purchasing the asset, at the time of purchasing the asset should be reduced.
Yeah.
Okay? Yeah. And simple, debit the asset account, credit bank account if you have paid cash, or the liability, the supplier's name. Okay?
Hi, good morning, sir.
Good morning, Rupa. How are you?
I'm good, sir. There was a power cut at my place, so it just
Oh,
closed.
okay, okay. Yeah. Just we are repeating the yesterday's class. Yep.
Okay.
Right. So debit the asset. Do not expense when the benefit is greater than a year. Even if you take a Xerox machine, photocopier, the benefit is greater than a year. So therefore, the amount which you pay on purchasing a photocopier or Xerox machine is to be capitalized rather expensed. Capitalization means recording it as an asset so that you will have depreciation. And the cost of this asset, say for example, you purchased a Xerox machine for say 10,000 rupees and the life is say 5 years. It has to be this cost is to be recovered in 5 years time. Okay, that is the reason why you charge this amount and you call it as depreciation. Each year you will record it as
2000.
depreciation as an expense 2000. Yeah. The initial measurement includes acquisition, construction, production, etc. Everything. But the interest which you paid, the interest which you paid on construction of any asset which is used internal purpose is to be
Total use.
capitalized. Okay, internal use. So condition is please write down one more point. Interest cost.
Internal.
Interest cost of acquisition, construction is to be included in the asset provided if the asset is used for internal use. The condition is very important.
Internalize.
Internal use. So there may be an MCQ based on this. Okay. The asset, if you purchase the asset, you by taking the loan and the asset is sold, interest is not to be capitalized. Interest is not to be added to the asset. Okay. So the condition is the interest is to be paid on acquisition, construction, or production of an asset. An asset must be used for only internal use. Yeah. And this asset, of course, including interest, can be depreciated. Yeah. And this one very important is in the case of land. In the case of land, the cost includes not only the amount paid to the owner of the asset, but it includes surveying cost, commissioning, title search, finder's fee, clearing charges, etc., etc. But but after the acquisition of land, whatever the cost you pay, say for example, you are laying the foundation here, okay, etc., not is not to be allowed. But grading is allowed. Grading, grading of the land at the time of registration is allowed. Yeah. So land cost includes surveying, commissioning, title search, that is finder's fee. You can also see the finder's fee
Till the registration our name.
till the registration. And even after registration also some grading will be there. So the land may
Grading.
be
Yeah, yeah.
not
Grading.
in a good position. Okay, plus
Grading.
grading. So please write land cost includes surveying, commissioning, finder's fee, clearing, grading. Okay. And one more important point is there is no depreciation on land.
Yeah.
There is no depreciation on land. On building, depreciation will be there. So you purchased land, and on this you laid foundation, you laid walls, etc., etc. Up to the land, acquisition of land. This on this no depreciation, and you constructed a house on this. Of course, this will have depreciation. What amount you paid for? Clear? This amount will subject to subject to depreciation, but this amount is not allowed for depreciation. Okay, so on the land you will have depreciation, but on the building you will not have any depreciation. Clear?
The
So
building depreciation.
yeah, building is
Land
allowed.
is don't have.
Land is not allowed. Say for example, for building you spent around 10 million. For land you paid around 5 million. So land and buildings will be 15 million, isn't it? So
Building only
on this
depreciation.
no depreciation is allowed, but on 10 million depreciation is allowed. The total you will have 15 million. Clear?
Correct.
Yeah. So property, plant and equipment are the tangible assets. Natural resources like mines, etc., and of course land. Here, in the case of tangible assets, property, plant and equipment, we call it as uh, depreciation. Here we call it as depletion. Here also depreciation only, but we call it as depletion and no depreciation. Okay. And in the case of goodwill, it is called as amortization. Amortization. decrease in the value of an asset is called as amortization, like goodwill, patents, copyrights, etc. Okay, now cost of the long-term assets like building includes purchase price, sales taxes, finder's fee, yeah, any registration charges, etc., can be added. In the case of equipment, we discussed, but in the case of land, very important is the purchase price, taxes, finder's fee, real estate commission, etc., uh, and grading of the asset, that is cost of the removal of old assets, okay, and grading costs. But no extra expenses like you dig the pits for planting, etc., or compound wall, yeah, they are not allowed.
Compound wall is include building, no? Related to the building.
Yeah, and also here buildings painting cost, housewarming cost, etc., is not allowed, yeah.
Repairs and
That
Yeah,
expenses.
because painting itself is a, again, it will go
maintenance.
after the registration, that will go into
Yeah.
expenses.
Expenses.
Yeah, so painting of building is not allowed. Any, any digging of pits or construction of compound wall, etc., is not allowed in the case of land. Very important, please. There may be a confusion in the MCQs. Okay, Mr. Kalyan,
Yes.
no confusion between C and CMA. Okay,
Okay.
yeah.
Yeah.
So any painting cost, repairs to buildings when you purchase buildings, housewarming, etc., are not allowed for depreciation and not allowed to be
Yeah.
added to buildings.
Yeah.
And in the case of land, up to grading is okay, and you dig pits for
Mm.
planting, etc., which is not allowed. Even compound wall is also not allowed.
Okay.
If any
Yes.
old building is there, you removed, that is okay. That can be added to land. Yes. Important terms are depreciation, amortization. Depreciation is an amount charged on the tangible assets. Amortization is an amount charged on intangible assets. Intangible assets. In all the cases, the entry is depreciation account debit, asset account credit. But here, depreciation account debit, or accumulated depreciation account credit, because we directly do not charge to the asset. Yes, Rupa?
Yes, sir.
Yeah. Estimated useful life. Mostly, we see the economic life of the asset when we purchase the asset, except land. So, this is useful. This is very much useful in finding the depreciation amount. Say, for example, the economic life of an asset is, say, 5 years. So, obviously, the depreciation would be 20%. If the life of the equipment, office equipment is, say, 3 years, so the depreciation would be 33%. So, estimated useful life of an asset plays a key role in finding the depreciation. Yep. Salvage value or residual value is an amount which is recovered at the end of estimated useful life of the asset. It is useful in a straight line method because we use this amount from the cost of the asset and divided by estimated life will give you annual depreciation. Okay. Carrying amount. Carrying amount or net book value of an asset, which is the difference between the original cost of the asset and the accumulated depreciation as on that date. So carrying value equals to net book value, which is the difference between original cost of the asset and the accumulated depreciation as on that date. Historical cost or original cost minus accumulated depreciation, impairment losses. Any impairment losses should also be recognized. Impairment loss means if any asset cannot be used but still the life is there as per the books. Any asset which cannot be used but still the life is there, and the asset has to be impaired. Impaired means it has to be depreciated. It is to be depreciated. That is called impairment losses. Say for example, a vehicle. A vehicle is completely damaged. We can't do anything, and there is no insurance, say for example. So it has to be impaired. Again, impairment also, the entry would be impairment loss, debit, accumulated depreciation, credit. Okay. So depreciation account debit, accumulated depreciation account credit. So followed by, if you write the asset name, so that it would be good that it will go into that asset schedule,
Individual asset, yeah.
because the amount of depreciation differs on different asset schedules. Like buildings depreciation rate is different, plant depreciation rate is different, vehicles depreciation rate is different. So better you need to give the names of the assets here. Clear? Of anyway, you are into management accounting, they won't ask you to pass journal entries and all. But for your knowledge, always when we have an account followed by which asset schedule you are charging depreciation, that is important. Accumulated depreciation is to be maintained. Accumulated depreciation is to be maintained until the total depreciation becomes equal to the asset value. Means always depreciation account debit, accumulated depreciation credit. So depreciation goes to income statement, right? This
Yes,
goes
sir.
to income
Income.
statement, and this goes to balance sheet.
Balance sheet.
Balance.
Will be deducted from the asset value.
Awesome.
Okay. We discussed about capital expenditure, revenue expenditure. What is the criteria, Rupa, to rate an expenditure as capital expenditure? Criteria should be the benefit should be greater
Equal
than a year.
1 year.
More than a year.
Yeah. If the benefit is less than a year, we record it as
Yeah.
OPEX.
Revenue.
Example,
No.
our salary, isn't it?
No.
Salary is the revenue expenditure. Hmm? Example, like utilities. Utilities. We purchase office supplies like stationery, etc., etc. They are all revenue expenses. Yeah. Depreciation methods we discussed: straight line, declining balances, units of production,
Units of
sum of the
production.
years.
Sum
Sum of the
Yeah.
year.
Straight line method, we discussed that the depreciation will be same every year. Yeah. What is the depreciation? Annual depreciation. What is the annual depreciation?
E.
3,600. 3,600.
Mr. Rajesh Hyderabad. Mr. Rajesh.
3,600.
Yeah.
Yes,
3000?
sir. 3,600.
3600. Very
600.
good. Very good. Very good. Based on the life in miles per mile, please. Per mile.
Per mile. 3,600.
0.04.
90,000. 3,600 divided by 90,000.
No, 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 no.
0.040.
No, no, no. Not depreciate. This miles also yearly, Rajesh.
Okay, okay, okay.
This is yearly, no, sorry, lifelong, not yearly. So 20,000
20,000
minus 2,000
divided by
divided by 90,000.
Point two.
It is going to be point
Point two.
040.
for, so 20 cents per this one.
Okay.
Else if it is 5 years, 20,000 minus 2,000 divided by 5.
Right.
Here it is going to be 3,600. This is the production fractional method, okay,
In
based
the
on the
production.
production, based on the production. Okay, cost of the asset minus residual value divided by useful life, 3,600. Depreciation is an expense. In the each year income statement, it will go to debit side of income statement, and also the balance sheet, it will be deducted from the asset value.
asset.
Okay, so 2000, 2003, 2003, 2004, 2004, like that until fifth year. So each year 3,600. At the end of the year, can I have 3,600 times 5, please? 18,000.
18,000.
18,000, and you will have residual value of 2,000. Yeah. Fractional period. Fractional period depreciation means it is not a rule that every year you'll have to buy depreciation only on January 1st. No need. Yeah. When an asset is purchased during the year, what you need to do is, when was it purchased? When was it purchased? Say April 1st. April 1st. April 1st to 31st December. April 1st to 31st December, 9 months. So first year you need to calculate depreciation on 9 months only. Okay. Second year onwards, same. Second year onwards, it will be same. Say for example, depreciation expense, we have 100,000 worth of asset with a salvage value of 10,000. Okay, and depreciation is say 25%. Can all of you calculate depreciation? 100,000 asset, 100,000 the asset value, 10,000 salvage value, 25% depreciation, and the asset was purchased on 1st of April. Calculate the depreciation, please. 16,000,
875.
16,875. That
Yes.
is 100 minus 10,000 times 25%.
25.
Because it was purchased on 1st of April, so 1st of April to 31st December, 9 over 12. Okay, 100,000 minus 10,000 times 25% times 9 by 12. Second year onwards, same. 100,000 minus 10% times 25%. You no need to do this. Only in the first year, you used for only 9 months. So you'll have to calculate the fractional depreciation. Okay, 9 by 12. And in the last year, fifth year, say if we sold it, on March 31st. Can I have the depreciation for March 31st, please? Last year, how many months we used it for?
Two.
March means 3 months.
3 months. So 100,000 minus
5,000.
Is it 5,000? Nobody is calculating, I think. Why? Kalyan Garu. I know I'm not getting the answer from you. 5625, right?
Yes,
Sir,
Yeah,
5,000.
5,600.
Salvage
10,000
value is
salvage.
10,000. Same value.
So we are taking 27.
Okay, okay. 10,000. Now, what is the carrying value for 5 years? All of you, please. I want to know the carrying value at the end of 31st March, 5th year. What is the carrying value of the asset?
94,375.
Very good, very good. See, she is working. Nobody is working. Why? Huh?
Yes.
Nobody is telling me the answer. Kalyan Garu. What happened? 100,000. Okay. Salvage value is 10,000. Okay. Right. Here, year, depreciation, accumulated depreciation. Okay. And the carrying value. First year, depreciation. How much? 100,000. Right? 100,000 minus 10,000, no?
Minus 10,000
90,000 times
into
25% times 9
92.
over 12.
9 over.
Accumulated depreciation also same value, isn't it?
Yes.
Okay, now what is the carrying value? 100,000,
1 lakh minus 16,800.
16,875. Clear?
8.
Second year, 90,000 into 20%, 25%. Okay, this amount plus this amount. What is the carrying value?
1 lakh minus 22,500. 77,500. So, sorry. 83, 125 plus
What
60,000.
happened?
60,000. 65 minus 20. 38,125.
38,125. Very good. Fourth,
Minus 22,000. 15,625.
hmm?
15,625.
16,625. Okay, fifth year.
15,625.
Yeah, fifth year we sold it for
Three sold at
90,000. Sold. Let us not calculate sold. Calculation of depreciation into 3 over 12, right?
3
Wait.
or 5,625.
So we can calculate like this also 22,500 minus
10,000.
16,900.
Yeah. So the value would be this much, 10,000.
10,000.
Clear? And if this asset is sold for 8,000, sold for 8,000, what is the carrying value as on this date?
2,000.
10,000, right? 10,000, no?
Yes.
10,000. And it is sold for 8,000. Rupa, clearly, it should be understood very clearly, Rupa.
Yes, sir.
First year you purchased for 100,000. At the time, debit asset account, credit bank account. How much? 100,000 and 100,000. Clear? Each year after this, each year you will record like this: debit depreciation, credit accumulated depreciation. Each year, some amount, some amount. Each year, these amounts you'll have to pass entries. Yeah? Say third year, 22,500, 22,500. Fourth year, 22,500, 22. Fifth year, 5625, 5625. This is the recurring entry. This is the recurring entry. This is the purchase entry. Now you sold for 8,000. Means the asset which is valued 10,000 is sold. Debit bank account. Bank account. You are getting 8,000. And credit asset account. You are selling the value of the asset 10,000.
2,000 loss.
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 On sale.
Loss.
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 So here you will write loss on sale.
Sales. Goodwill statement.
This will go to profit and loss account. Loss on sale of asset. If the asset is sold for say 10,200, 10,200.
200.
It's a gain. Credit gain.
So the bank account will be same, but you will be getting 10,200.
10,200.
Asset account will be same, 10,000,
10,000.
because the asset value is only 10,000. And you will
Gain
have
on
one
sale.
more gain.
Gain on sale.
You will write gain. Don't call it as profit, gain on sale. 200.
200.
It should be like this. So maximum entries you learned here, Rupert. Just practice this, please. Okay. This yellow color, yellow shaded is yearly, recurring. For this amount, first year, second year, third year, fourth year, fifth year, recurring. But these entries will be only once. They appear only once. This is condition 1, condition 2. Means if the asset is sold for loss, if the asset is sold for gain. Okay. Yeah. Shall I close it? Record it. Rest all you know this one, but Rupa, shall I close this or record it?
Yes, sir. Yes, sir.
You noted?
Yes,
Yeah, good. Yeah. Units of production method. If the asset is purchased like this, and this has to be depreciated by using the units, like in the previous example, miles, Mr. Rajesh Gowda. Yesterday we discussed about it. If the asset is purchased or depreciated using units of production method, so what we need to do is, say for example, 100,000 is the asset, and during the lifetime we can produce say 120,000 units. Okay, so the depreciation will be like this. Per unit it is going to be 0.833. So here units produced and depreciation. Say for example, first year you produced 12,000 units. So depreciation is going to be 12,000 times this one. Units of production. Okay. Yeah. Like this. This is an example. Accelerated method. This is called diminishing balances method or written down value method. So under this method, the depreciation is calculated on the depreciated values. So here you will have declining balances method, sum of the years digits method, which we discussed yesterday. In this case, what happens is the depreciation will get reduced year by year. Yep. Like this. 20,000 depreciation is charged, 8,000, the ending book balance would be 12,000. Next year we will charge depreciation on 12,000, say 40%, 4,800. 12,800 minus 4,800, it goes on like this, decreasing the depreciation and calculating again. Yeah. Sum of the years digit method, yesterday we calculated, and also what is that formula which we used?
And
N into
10% by
n
12.
plus 1 by 2.
By 2.
Yeah. These are the examples. Group and composite depreciation. In most of the companies, what happens is the amount of depreciation is to be grouped, not to be calculated depreciation on each and every asset. Yeah. Say for example, you have 10 buildings. All the 10 buildings will be grouped, scheduled. In one schedule, we calculate depreciation. You have 100 vehicles. Don't depreciate on 100 vehicles, each and every vehicle. You calculate vehicles, one heading, vehicles into the group depreciation. Same the entry, cash account debit, accumulated depreciation when asset is sold. Impairment. Impairment means when an asset cannot be put into use now. Okay, but the life is there. Say for example, an asset was purchased in the year 1 and the life is say 5 years. Third year, the asset met with an accident and cannot be used at all. We used successfully for 1 and 2. 2 years we used. Third year it met with an accident. We cannot use it. But still the life is there. So the asset has to be
Physically,
impaired.
physically not fitted, but book
Yeah,
value is there.
yeah, value is there, book value is there, but physically cannot be fit for usage, normal usage. Say for example, asset is purchased for 10,000 and the useful life is 5 years. What is the depreciation covered here in the first year? 2,000, right?
2000,
What is the carrying value? 8,000.
8000.
Second year, one more 2,000. Carrying value is 6,000. Third year, one more 2,000. 4,000. At the end of third year, the asset is, impaired. In a sense, cannot be used now after this. And this is the value of an asset. 100% loss, for example. So for this, what we need to write is, again, the depreciation entry would be like impairment loss. Don't write depreciation. Depreciation is not allowed. Why? Because this will go and hit income statement. Okay. Impairment loss debit, accumulated credit, accumulated depreciation credit. Okay. Debit and credit. Always you should see that asset book value is greater than the future cash flows or not. Hmm? Asset book value should be greater than the future cash flows what we get. And the entry is also important. Impairment loss account debit, accumulated depreciation credit. When we sell asset, already we discussed bank account debit, yeah,
Credit.
asset account credit, but profit or gain or loss is to be recognized. Always bank account should be debited, asset account should be credited, and the remaining portion will go to loss or gain after the adjustment of accumulated depreciation. Hmm? What amount you received? In my previous example, 8,000 you received, and accumulated depreciation you removed. historical cost of the asset, total amount of the asset. The balance, this will be question mark. In my first example, 10,000 worth of asset was sold for 8,000, balance was 2,000. In second example, 10,000 worth of asset was sold for 10,200, there is a gain of 200. Yeah.
Yeah.
So record your cash, accumulated depreciation, and also gain or loss is to be accounted after receiving the book value. It can be loss also. I mentioned two conditions. If the cash received is higher than the amount, it is called gain, otherwise it is a loss. Intangible assets, other than tangible assets, whatever the asset we have which do not have any physical existence. Physical existence is called as intangible assets. In a CMA examination, you need to concentrate more on patents, please. Patents. Patents, as per the US Patents Act, can be written off in 17 years. Please write down somewhere 17 years. Okay. Say, for example, you purchased a patent rights for 8 years. 8 years will be compared with 17 years. Whichever is less, the patents are to be written off in those years. Mr. Ashok.
Okay.
If you paid for say 120,000 to acquire some patent rights, and the owner of the patents issued the rights to you for say for example 6 years. So 6 years, 17 years. The criteria is to check like this, whichever is less.
Lawyer, absolute.
So it has to be amortized only in 6 years.
6 years.
So each year you will charge 20,000. Agreed? Mr. Kalyan?
Yes.
Yes, sir.
Rajesh.
Yes, sir.
So Rajesh, Hyderabad.
Correct, sir.
Yes, sir. Yes,
Yeah.
sir.
You understood, no? I'm not using the word depreciation.
Yeah,
It is
understood.
amortization.
Both of this.
Yeah. Say for example, it is not 6 years, it is acquired for 20 years. Rupa, then what is amortization per year?
6.
22.
7,050.
20.
What is the amortization? The patent,
7058.
the patent rights are acquired for 120,000 with a right
20
period
years,
of 20 years. How much you will charge each year?
705.
17
7,000.
only, sir.
It is
17 like year.
120,000 divided by 17 because whichever is less,
7,000.
it
Yeah.
has to be absorbed in 7.
7,050.
Yes. Okay. One more important point as per GAAP and IFRS rule is that any asset, any asset, if developed internally, like goodwill, okay, any other asset like that, if it is internally developed, R&D should be expensed. You will have R&D and other subsequent expenses. This should be expensed. For the last 2 years, 2 or 3 years back, this rule has come that R&D is to be expensed, but the rest of the amount is to be capitalized. So on this, you can expect amortization. Sorry, Rupa?
Yes, sir.
In the case of research and development, this is to be expensed. Whatever the amount you spend on R&D should be expensed in the period you spend, but the additional cost is to be capitalized.
Example, running industry purchasing new land. For the
Exactly.
searching of land, we can make it as a R&D,
But we
right?
are
Searching of
discussing
land
about
expenses.
intangible
The
assets.
pattern, intangible.
Intangible
Okay.
assets. So intangible asset, we call it as amortization. Same, you can say depreciation rule, but the title should be amortization. So amortization expense debit, intangible asset credit. And don't write accumulated amortization, please, because here there is no question of accumulated amortization like accumulated depreciation. Amortization debit, intangible asset credit. Okay, and how much amortized so far? That is, the residual value is to be deducted from historical value, how much you acquired for. So most of the companies think that the goodwill cannot be, you know, nobody says that my goodwill, my company goodwill is gone every year 25%. No, you can't say like that. The goodwill has to be developed, isn't it? So
Yeah.
most of the companies, they do not amortize goodwill because of indefinite value.
Definitely.
Yeah.
Goodwill is nothing but repetition. Nobody says that repetition is to be
My
depreciated.
reputation is going at least.
So it's a bad remark, no?
Mm.
It is a bad remark. Unless the company faces some issues or the losses, etc., they cannot depreciate goodwill, amortize goodwill. Okay. Any asset is impairment. You need to have two tests. One is quantitative test, qualitative test. Okay. Please write down impairment tests, quantitative and qualitative. Qualitative test, the quality of the asset. Okay. If the quality of the asset is, the probability is greater than 50%, okay, do not impair it. If it is less than 50%, impair it. Quantitative, the fair value, means the current market value. If the carrying value of the asset is greater than the fair market value, then the asset is to be impaired. Okay. If the carrying value is less than the fair market value, not to be impaired. Fair market value means the present value in the market. Okay. Impairment loss cannot be reversed back again. It has to be charged to the profit and loss account. It is a non-reversible. Okay. And also please write one more important difference between IFRS and GAAP, that a one-step quantitative impairment test is performed, but no qualitative test. So in GAAP, you have GAAP two tests, right? What are they? Quantitative and qualitative.
Quantitative and
But in
qualitative.
IFRS, only one test. What is that?
Quantitative.
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 Here quantitative and qualitative. Okay, now let's see some questions here.